Dear friends, thank you for supporting this channel on Patreon to join our growing family of donors, now 59 patrons strong. And remember, once we reach 100 active patrons, we will start sending out a 1-ounce U.S. Silver Eagle, autographed by your host, Dunnigan Kaiser, to one active supporter each and every month. Thanks for taking a minute to pitch in by going to patreon.com/reluctantpreppers and pledging your support today. Thanks very much.
As a responsible person with growing concerns for your privacy and personal liberty, you want to know where we're headed and what you can do about it. We ask the experts what you need to do to take prudent and responsible action to safeguard your family's wealth and well-being, and what basic first steps will help you to be aware and prepared. ReluctantPreppers.com.
Welcome back, Reluctant Preppers. We're delighted to have this returning guest. Lynette Zang is the Chief Market Strategist at ITM Trading. She's been with us several times on Reluctant Preppers, talking to us about things that are happening in the markets, the realities of real money versus fiat and equities, and what people can do to reduce their exposure to risk and to prepare their families to weather whatever storms come ahead. And also, she's been quite generous to share her personal progress reports on her backyard urban farming. So, Lynette, thank you for joining us once again on Reluctant Preppers.
It's always a pleasure to be here, Dunnigan. You know, what you do is very close to my heart, so I'm always happy to be here.
We're glad that you invited us. Actually, I want to give you credit for this. You are the one who invited us to start branching out beyond the audio-only sort of radio format that we had been on for like 4 years before you're coming on. You said, I'd like to be on your channel. When we asked, and you said, but I'd like to do it full video if we could. And we said, okay, we'll figure out how to do that. So you've really opened up a new chapter for us, and we've gotten a lot of positive comments from our viewers on that. They really appreciate the increased interest and the personal connection that they get through being able to see our guests. And just this interview for the first time, I'm coming on screen too. So it's
wonderful.
It's a whole new beginning for us, and I just wanted to take a moment to plug our sister channel that we've started in combination with this, which is healingyourself.life, talking about all kinds of health and wellness things. So people jump on over to healingyourself.life and check that out and subscribe there as well, and you'll get more and of my lovely wife Melody being able to share our stories, and a lot of experts there. But if we could circle back with you, Lynette, on what the heck is going on in the financial markets. When we had you on in early February, you gave us a real heads up from the educational pages of the Federal Reserve website. You say you like to use data, but more than ever, you like to use their own data to point out what's really going on that you're not going to hear about on the mainstream media. And you showed us this cliff drop-off in interbank lending, and you made the connection for us about the concerns of liquidity and the concerns of loss of trust between banks, who are well aware of the risks that each other are facing and not wanting to increase their risk exposure. Meanwhile, the rest of us are happily just sending in our 401k contributions and everything else blissfully participating in that risk exposure. And then we circled back with you in March because we had quite a bit of controversy from comments that people had entered about that, saying, oh, they just discontinued the chart, so you were just seeing kind of an artifact of a drop-off in the data. And you said, well, they did discontinue the chart, and it's one of those things that didn't look too good. And lo and behold, that was your famous Something Nasty This Way Comes interview with us, and lo and behold, the market started tumbling and staggering after they'd been just monotonically increasing with just eerily unnatural low volatility for years prior to that. Yes. And then we also saw stumbling in the bond market, stumbling in the cryptocurrencies, getting a 50% or more haircut. So could you just bring us up to date with what your latest research is showing you about this major period that seems to, all the first quarter seems to be a departure from the previous years, and what you're seeing, whether you see it as just a momentary, normal, healthy correction in an otherwise secular bull market, or do you see this as really a turning point and a tide change for the markets?
Well, actually, I don't see this as a normal bull market anyway. This is a central bank-led bull market to cover up the death of the global financial system that happened in 2008. And actually, even though I said something nasty this way comes, because really what I've been witnessing heavily since October are a lot of pattern shifts. And honestly, anybody, that's what I try and do in my YouTube videos, is point out the patterns and point out when they shift. Because if you don't really need to know all of these little nuances, but you need to have the ability to look at what's really happening. So I like to say I listen to what the central bankers say, but then I look at what they do. And if what they do supports what they say, well, then it's probably the truth. But if what they're doing is different than what they're saying, then I know that it's a lie. And that's one of the reasons why I really like that FRED, the Federal Reserve FRED. You can Google it and go in there and look at all of those charts and graphs. But what's happening right now is really kind of interesting because, excuse me, I think at the beginning of the year, when President Trump changed those tax laws, and you're going to hear this a lot now because now we're coming into the first quarter's earnings season. But the change in those tax laws enabled corporations to post like 20%-ish, give or take a little bit, but roughly 20% per share gains. So in many ways, the anticipation of this is what drove the stock market pretty much straight up in January. But then on top of that, allowing them, and understand that tax cut was from a 35% to a 21%. You and I did not get that big of a tax cut.
Right. And
that one is permanent. This one is temporary. Okay?
For individuals.
For us, the citizens, right. That's temporary. So that will expire. But in the meantime, it's going to make us look like we're doing really well because our paychecks are a little bit bigger. And so the hope is that we'll go out and spend that money. Sure. Don't save it. Don't save it for a rainy day. Go spend that.
Yeah, don't be a hoarder, huh?
Right, exactly. Well, if you hold cash in a bank safe deposit box or bullion, metals, then you're classified as a hoarder. If you leave it in the savings account or checking account, well, that's okay. You're not hoarding
but
that.
Before we get off that point, I know we've talked about it before, but please, there's going to be a lot of new people who've never watched you before and they've never watched our channel before. Can you please just take 1 minute to tell about how far from people's expectation that decision is to put money in the bank and think that your money is in the bank and is waiting for you there versus the whole thing about being an unsecured depositor? Can you just take a minute or two to tell people this is the real deal, people?
This is a real deal, and this happened in 95. A lot of changes happened in the mid-90s, and this is one of them, where they legalized sweeping any of your deposits, and that's actually what it's called. Okay, sweeping your deposits into a sub-account. And then the banks have access to use your deposits as collateral, borrow, and then they can do anything they want with your money. Okay, and since you brought that up, now this one isn't going in until I think next week's YouTube video, but I was a little curious as to the current profit margins of the banks. Because we reveal all of the fees, and people never like to pay fees. They don't mind paying them if they don't know. But now we think that the banks aren't making any money off of us. Maybe they don't charge us anything. Maybe they even pay us a little bit of interest, which is what enables them to sweep that account because you're loaning them that money. And many of you may have noticed that after 2008 in your checking account, all of a sudden you got a 1 penny interest, right? And I notice it every now and again in my checking account, and a penny's worth of interest shows up. Well, if you pay interest on something, well, that's debt, right? I mean, you don't pay interest if you don't have debt. So legally, you have loaned the bank that money. That's what enables them to sweep it into those sub-accounts and then use that to, well, they could loan money out. I mean, we all have been taught that that's what banks do, right, in a fractional reserve system.
Yeah.
But they can also use them for derivatives.
Wait a minute. I watch It's a Wonderful Life with Jimmy Stewart, and the guy came in to subtract the money, withdraw money from the bank, and he said, "Well, you know your money's not here. It's out in Mrs. So-and-so's front porch, and it's Mr. So-and-so's new addition he just put on his house. That's where your money is. It's working for the community." But you say to it, there's more going on than just that, right?
There is a whole lot more. Well, back then they didn't really securitize those loans. In other words, turn them into additional financial products and sell them off to other entities. They actually had skin in the game. So back when it was A Wonderful Life, that was how they were getting you used to the fractional reserve system. I mean, there's always a method to all madness. But today, actually, our banks, actually, the terms have been loosening up a bit. So we're going back, and they've been doing a lot of deregulations in the banking sector, allowing them to take on even more leverage. But really, the bank's profit margin on the bigger banks is almost 25%. That's their net profit. Net, 25%. Now, I wonder how they're making that on your savings and checking account. Or, like JP Morgan, a lot of them have their own products, right? So they now no longer are the banks that take your savings different than the banks that risk your savings. They're one and the same. That was the Glass-Steagall Act was put in place in 1933 to separate those two entities.
Okay.
And thanks to, it was Reuben Summers. It was Larry Summers that prevailed over this. Yeah, they got rid of that. So there's so much risk that's built into this system. But kind of going back to your original question about what's going on, it's really kind of interesting because the whole point of the tax cuts and the repatriation was to bring liquidity back into these markets and keep the stock market going up. Now, I think that he did anticipate that he was going to start to battle the tariffs or battle the trade, bilateral trade agreements, NAFTA, TPP, and
Sure.
particularly with China.
Yeah.
And of course, that's really what's been part of what's been roiling these markets. But the real problem is, and if you listen to CNBC or Bloomberg or any of those Main Street kind of market shows, what they're talking about, oh no, it's not that there are sellers, there are just a lack of buyers. Now, this is true. There's no liquidity in these markets, Dunnigan. And so as long as they can keep people in them, then it doesn't enough, then it doesn't show up. But when you get a rush to the doors, you get what we've been getting. All of the volatility has come back because these markets are not liquid. A $700 down or a 700-point down day means there are no buyers and lots of sellers. And so what really they want is they want you to hold, there's your 401ks, your IRAs, your variable annuities, all of those things for the individuals were classified as sticky investors, because once people make a choice, they usually don't change it very rapidly. Hedge funds, those kinds of guys are what's called hot money because they'll make a big deposit, but then they're likely to make a big withdrawal as well. So you and I are sticky. They know that once we've made a choice, we're not likely to change that, and therefore we are willing to leave our wealth vulnerable because the perception is that we own that mutual fund or we own that annuity. What you own is a contract. That's what you own. You do not own the underlying asset or the underlying instrument for that matter. You own a contract. And that means that any contract is only as good as the counterparty to that contract.
Right.
So as long as they can make good, all right, no problem. But when they can't, too bad, so sad. And what are you going to do? You and I are not too big to fail if that hasn't been hammered home enough with all of the behavior.
Right.
So, it's kind of interesting. We're at a really interesting point, because what I'm seeing in my charts and graphs is a massive deterioration. On some levels, it doesn't make sense to me simply because of the tax law changes, which really impacts the bottom line for these corporations, right, by somewhere around 20%.
Are you saying, in what you just said, I want to make sure we're tracking you, that
yes,
the tax law changes, which should be beneficial to the company's bottom line, should support future earnings and stock price and that sort of thing. However, we're seeing a stumbling, current earnings. Yeah. I'm sorry.
Right.
But you're seeing the stumbling of the stock prices, and you're saying, what's that about?
Well, I know that it's about the war that we've got going on with China and the tariffs, and and we threaten tariffs of a certain level, and then China comes out and threatens tariff levels at a certain level,
sure.
The same level, and back and forth. So it's kind of a tit for tat kind of thing going on. But it is also kind of interesting that the new earnings projections, which then makes the stock market not look like the most expensive stock market in history, right? Plus the trillions of dollars that are coming back that are being repatriated at, let's see, what is it? Well, 15%.
Right.
15%, okay, tax rate. And all of the stock buybacks. So a lot of that money, so far they said that they're going to put about $82 billion in new buybacks in there. Those two things should create a higher stock market.
So
though it's all artificial.
If we can make sure we understand, let's track you on this one as well. Because companies have for a long time tried to avoid paying U.S. federal corporate tax of 36, 39%, some high number. They've basically taken their profits. Sometimes they've moved their manufacturing operations overseas. They've moved other profit centers overseas. They haven't brought that money back home. They've left it overseas. Somebody had some quotation that Microsoft has. I forget if it was 95% or some huge amount of its money is held overseas. And they don't want to bring it back. They didn't want to bring it back because they'd have to be stung with paying this huge corporate tax, this repatriation tax to bring those profits back home to build factories here, for example, instead of overseas, that kind of thing. But now with Trump having lowered the U.S. domestic corporate tax rate, that kind of is a windfall, I would say an open door, kind of almost like an amnesty period to bring home those monies. And the hope was that they would bring that money back and invest it in building up making America great again or whatever. But instead, you're saying a lot of those companies are using that money, the cash that they made overseas, by taking jobs over there instead of here and that kind of thing, and they're just using it to just buy back their own stock, which is again kind of
a chunk of
inflates up the stock valuations. Right. Okay.
And let's be clear on that when we're talking about repatriation, because President Bush also allowed repatriation, I think it was in 2005. And so that money went back into special dividends and stock buybacks. So it went to the top. It didn't really trickle down.
Okay.
And so it wasn't so much that they didn't want to pay the tax. So that's certainly true. But they knew that if they accumulated it over there and they just withheld it, at some point they were going to have another gift. So they were doing that in anticipation of this gift. And yeah, 21% on current earnings is really nice, but 15% on repatriated earnings is even better. Okay. And yes, they're doing some bonuses. So they knew, everybody was watching that. Everybody was saying, okay, what are they going to do with the repatriated cash? Because we know what actually happened the last time.
Okay.
But the corporations have actually announced $82 billion so far in stock buybacks. Now, how much they're actually going to do has yet to be seen, but that was the announcement. And typically an announcement like that is going to push the stock markets higher anyway. Right? In anticipation. And a lot of times people say, well, what's wrong with stock buybacks? I mean, it reduces the number of shares outstanding, and it does definitely make things look better. And I don't, in general, I mean, it really does depend on why they're buying back the stock.
Yep.
Okay? Sometimes it is, or the theory is that there's nothing else that's better for the use of their money than to buy back stock shares. And doesn't that help the shareholders? Well, it kind of depends on if you're doing it with cash or you're doing it with debt. And with interest rates as low as they were, we also have corporate debt levels at the highest that they've ever been. And a lot of that is coming due this year. A lot of it. And so it's coming due. Normally, they would just keep rolling it over and rolling it over. But it's coming due in an environment where interest rates, you mentioned about bonds, where we are in a rising interest rate environment.
Right.
And that, too, is central bank, well, Federal Reserve led. And, you know, they're not raising. Let's be clear on what interest rates are and the function of them for central banks, because when they want to stimulate the economy, in other words, get people to borrow and spend, they would drop interest rates down, and that would encourage people to borrow and spend. If inflation started going too high, too fast, so in other words, it became noticeable, then they want to slow that down. So they raise interest rates, and then that inhibits borrowing and spending. And so that's how a central bank regulates the speed of inflation, though that inflation is constantly compounding.
Right.
But with everybody stuck near zero, that means they don't have that tool. And that was a key tool in their arsenal. Does that make sense?
Yeah, you can't lower once you. It's like if that's your speed knob, and by turning it down you try to speed things up, and you're already at zero, you don't have anywhere to go. Yeah.
Right, except for negative.
Yeah. Wow, that's true.
Right?
Yep.
And that was the big experiment with Europe and Japan. Sweden started it, Switzerland, etc. Those negative interest rates, because historically that's never been done before. It doesn't make any sense. I'm going to pay you to borrow money from me. I don't know if you're going to be able to pay me back. In fact, if you're a sovereign government, the only way that you're going to be able to pay me back is by devaluing your currency and giving me back, in this country, dollars currency, that buy less and less, right? So don't you think that's a good deal? I'll pay you to do that to me. No, it doesn't make sense. It's illogical, which is why it never happened before. But they tested the parameters and what people would accept and how they would respond to that, and they discovered that people take out cash and they hoard it at their houses, hoarding it. In Japan, they ran out of certain safes.
Yeah, safes, that's right.
People, you remember that?
Yeah,
right?
Yes, I do. Yeah.
Exactly. And so that led them to understand completely that they have to get rid of cash if they're going to go on that metric. But make no mistake about it, Yellen said it, Powell said it, so the heads of the Federal Reserve has said that they need to create that interest rate buffer. The goal is to get it up to 3.25%. The problem is that won't be enough anyway, because on average, every time since the 80s, every time they've lowered the rates into a crisis to stimulate that spending, it's been about 5.5%. So even if they succeed in getting us up to 3.25%, and I don't think they even want to go higher, and that's because of derivatives. But even if they succeed and they do the average, that means we're already in negative rates.
Okay, so if they succeed at raising the rates to low threes, and then they, in the case of another financial crisis or in response to, oh my gosh, the economy's worse than we thought it was, have to drop by 5%, that pushes you into negative rate territory. Yep.
Right.
Along the way, you passed through briefly talking about rising interest rates, and I wondered if you can talk about what that does to. You mentioned briefly what it does to bonds. If you could touch on that, because many people have been saying to us that watch the bond market. I mean, Gregory Mannarino talks about that, and others have as well, saying that if there's going to be a collapse, or when there's going to be a collapse, watch it, because it's going to begin in the bond market, which dwarfs by size the other markets. And then if you could talk about a little bit about the impacts on real estate after that as well. So could we first look a little bit at bonds? What kind of risks do people need to be aware of?
Can I have a pen? Because it'll be easier for me to show you. Oops, thank you. Okay. These are interest rates. This is the principal of the bond. Bonds typically come out at par or at $1,000. And this is the also the term of the bond. So short term and then longer term. Okay, this is how bonds work. When interest rates go down, because bonds must always be valued at market based on the interest rate. So when interest rates go down, the principal of the bond goes up. The longer the maturity, the greater the fluctuation. When interest rates go up, the principal of the bond goes down. And again, you can see there's not as much movement short term as there is longer term. Okay, so that's how bonds work, and bonds are debt. Okay, so that's number one. Now, the bond market, remember, money is created in our system by constantly compounding debt. So you have to create debt. That's what the fractional reserve system is all about. You go in and you deposit $100 in your bank account. The bank then has the ability and the right to loan out $1,000. So whoever you got that $1,000 then makes that deposit, and they can keep loaning out, and on that new debt, they out. So that's how money's created in our system. And that's why it's the biggest system, dwarfs the stock market, dwarfs every other market, because that's how they create money.
The bond market. Okay.
The bond market. Gotcha. Absolutely. And no matter what the name is, it could be a bond, it could be a bill, it could be a note. Okay, those are all debt instruments. So that's number one. Now, as you saw, when interest rates go up, the principal value of the bond goes down. So interest rates have been at zero since 2008. Now, it's kind of an interesting thing, because governments around the world have been massively creating debt.
True.
As have the central banks.
True.
Okay, so you've got all these big entities that are basically, the central banks are monetizing all the spending of all of these governments. Okay. Now, something else that makes it a little more complicated, but you need to see the whole picture, is an on-the-run bond, which means a newly issued bond.
Okay.
And an off-the-run bond, which is in the secondary market. Okay, so
all right. It's been resold to somebody else? Secondary market meaning it's been resold, or what?
It's going to be resold, or it is being resold.
Okay.
Yes,
all right.
Absolutely. Okay, so the first issue, and then this is once it's already issued, then it's on the market to buy and sell.
just for ordinary people, when we bought our house, when we moved into our house and took out debt so that the mortgage company owns the house, that mortgage company we went through all the work of applying for and satisfying all of their requirements, and they did all the investigation, they did all the blah blah blah, all the underwriting, all the investigation. Then they flipped our mortgage. They right away, they just sold it off to some other company. So the one that we took out the mortgage from didn't hold on to it. They sold it right away. Is this analogous to what you're just talking about? There was the one who created the new debt, and then there's one who sold it? Okay.
No, that's what you're referring to is securitization. So in other words, yes, they sold your mortgage to another entity who puts this into a derivative package, your promise to pay that mortgage, or, I mean, there are different parts of your mortgage, so they can tear your mortgage apart and create a whole bunch of products from it.
All right.
Okay. But they put it in a package with a whole bunch of other mortgages, and that's a bet on whether or not you'll make the payment or something like that. What I'm really talking about is the price of the bond.
Sure.
Okay. Because when they're very first issued, well, yeah, you've got global central banks that are buying up lots of government debt, right? They're buying all the debts that the government can issue.
Yeah, as Rob Kirby says, why have we never had a failed bond auction in the U.S.? Because there's always a buyer there. It'll be the house. If the buyers don't show up, the house will buy it.
Exactly.
Yeah.
Exactly. But after it's already been issued, that's a different story.
Okay.
There are minimal, virtually no buyers on the secondary market. So who's been buying those bonds so that it doesn't impact the interest rate have been, pension funds. So they've transferred the risk of that secondary market onto pensioners where we already have a pension crisis.
Okay.
Okay. Now, a bond is a promise to repay. It's a debt instrument. It's a promise to repay. And we're sold that it's the safest thing that you can do.
Always. When they talk about what stage of life are you at and what mix of stocks and bonds should you have and how close to retirement are you, and earlier in your career stage, you always say, go heavy into stocks and small cap companies and foreign stocks and all this. And as you get closer into decades or approaching your retirement years, you better shift more heavier into bonds because it's much safer. Yep.
How is it safer? The Central Bank of Canada runs a report annually. They started, I think, in 2013 or 14, running a report annually on government bond defaults. And actually, I don't have that graph, but you know what? I'll send it to you.
Sure.
Send you the link.
I'd be happy to include it. Go ahead.
From the if you tell me Bank of Canada, I'll know which one I'm referring to. Where you're seeing more and more governments that are starting to default. Well, if you already know you're going to default on the pensions, that they're never going to get their pensions out, Social Security is a bust. Medicare, they're already substantially underfunded.
Right.
They're already running deficits. Does it really matter if you make that bomb even bigger? But what's really going to push us over are the bets that were created against the interest rates on the bonds, because interest rates were globally held so low for so long, and a derivative is just a big leveraged bet. That's all that it is. It doesn't necessarily have much. They can leverage 1 to 1,000.
Okay.
Right? So there is no way that, and the guys that create these big bets, these speculative bets, are also the ones to determine whether or not it's actually a default. And we've seen them do the ISDA. You want to talk about Ponzi scheme? When you get into the nuts and bolts of how the financial system has evolved from when it was a wonderful life to today, I'm very spiritual, but I'm not a particularly religious person. But I'll tell you what, it's Sodom and Gomorrah. Absolutely. The system is so corrupt and convoluted, and the guys that are doing it's all about wealth transfer. So those that are transferring your wealth invisibly through inflation and through all of these made up products that they just keep creating out of thin air, and it's magically now worth billions of dollars. Well, is it really worth billions of dollars, or has the dollar really lost that much value?
Right.
Okay. But we have confidence that the dollar, hey, I've had dollars my whole life. Well, anybody that was alive in 1971, guess what? In July of 1971, you had some partial gold backing. After August of 1971, it was all debt. But that dollar in your wallet looked the same.
Right.
So you didn't know that anything had changed.
Yep.
When in reality, everything had changed.
You've described the vulnerability of the bond market when people may think that that's a safe haven for their retirement, and it's not.
No, it's not.
How about real estate? And we've been told, Danielle DiMartino Booth talks about commercial real estate. If you mentioned no buyers are showing up at the secondary bond market, well, a lot of buyers aren't showing up at a lot of retail stores either, or a lot of service, restaurants or chains and that kind of stuff are closing lots and lots of stores. She talked about a coming crisis in commercial real estate that's going to be worsened
Absolutely.
by the increasing interest rate environment. Do you see that as well?
100%. In fact, we're already seeing a lot of cracks in that. In Manhattan, particularly, you've got a lot of those luxury buildings and hotels and condos that they're now cutting prices huge. And inside of that, remember, corporations in China have been on a massive global shopping spree, a lot of it into these properties. And now that's reversing. That reversed first with Ambang. Just about a month ago, the Chinese government took over Ambang, and they had a lot of luxury apartments and a lot of hotels, etc. And they started they've begun to sell off those properties. And I think it's HNA is another major Chinese corporation that bought a lot of real estate, particularly one thing to mention is the Hilton hotels. And they just announced a couple days ago that they were selling their position in the Hilton hotels because all of these purchases had shadow banking financing. Not all of it, but most of it was shadow banks. Now, a shadow bank is a corporation that performs some functions like loans and those kinds of things of banks, but they don't take deposits, which means they lack your cushion being a depositor, so for bail-in, right? So that's called a shadow bank, but there are a lot of funny products that were being sold that financed this in a lower interest rate environment, and that means that right? So as interest rates are rising, and they bought this property near high.
So the smart rats are leaving the ship. Again, you told us this in early February and in the equity markets. Now you're talking about it in the bond markets and the commercial real estate markets, and high-end residential real estate.
Absolutely.
Before we let you go, go ahead.
Well, I was just going to say something that we haven't talked about, and it's really significant, is that on actually, when I was doing my research, I stumbled across this, but in Venezuela, on February 5th, there was an official devaluation of their currency, and they've been in hyperinflation for a few years now, but an official devaluation of 99.6%. And then on February 7th, so 2 days later, there was an official reset against gold. And gold went up over 2,600 times, not percent, times. So that means that the clock is now ticking on mortgages, on fixed rate debt contracts, and on many things. So I'm excited to be watching that. I'm actually starting a series today. It'll be a 4 or 5 part series on what happens to money, what happens to mortgages, what happens to any other fixed rate contracts, insurance contracts, the bond market, the stock market, the gold and silver market. So that series is starting now because it's important, and we get a bird's eye view.
Now,
because we can watch it unfold.
Oh, in advance, in a different country that's a few steps ahead of us, perhaps in this train wreck. So it's like if you're on a train and the engine goes off the track and the second car goes off the track, and you're way back in the last sleeper car, and you're going, oh, "That's all right, I'm still on the tracks." It's like at least you're able to see what's happening. Hey, but what you just talked about, a lot of people have come on saying that in a inflationary environment where the value of the currency is being devalued, the biggest debtor wins. If you have your big huge mortgage on your house or your big huge bank loans or home equity loans or whatever, no problem, because when this huge inflation environment happens, you'll be able to easily pay off these debts in your inflated money. And you're saying,
only if.
Okay, go ahead.
Only if you have enough to do so. And that's the importance of gold. Because when they do an official reset, which is when, and usually on average, about 9 months-ish after the official reset is when mortgages and everything get what they call restructured. Okay. So yes, if you have the ability to pay off that mortgage and you're actually executing exactly the same strategy that governments are executing, which is to repay those debts with currency that has no value, but you have to have enough of it to be able to do that. And if you have gold.
Yes.
Yeah.
Yeah, I'm just trying to understand. You say enough of it. You have to have.
Well, that's what the gold. That's the function of gold.
Understood.
Okay?
I got you. Okay.
So you've got a $1 million mortgage, and spot in bolivars for a long time was 169 bolivars until they started into their hyperinflation. Right? You could buy an ounce of gold for 169 bolivars.
Okay. All right.
Now it's something like 3 million bolivars.
All right.
Okay, so you have to have the tool to convert into that paper to pay that mortgage off.
All right, so that's helping us to connect the dots there. Very helpful.
Right. And it isn't just that. It's easy to pay off because you got to have you still got to have in this country the dollars to pay it off.
Before we do have to break, you mentioned that tomorrow is a big day for you on your urban farming. Can you let people in on the what your milestone is tomorrow? Your backyard urban farming that you're doing.
We're finishing the bog.
So we were talking about floating forests or something in your pool. Is that what we're talking about?
Yes, I'm converting my pool into a swimming pond, and the floating islands should be here maybe in 2 weeks. We ordered them last week. It takes them about 2 weeks to make them, so maybe 2 or 3 more weeks. But I can plant all of that out with food.
Wow.
Plus, we're putting a small bog around, well, at least around this side. We're starting around this side, so I'm going to have a lot of growing area. But yeah, it's a masterpiece. I'll have to get you some pictures, and hey, maybe you'll come to Arizona and I'll give you a tour.
That would be exciting. That would be exciting. We've been talking about the possibility of what if we did a whole round the country tour, because we talk with people all over the place. I mean, it's just so great to go and see everybody's situation. Well, we've been speaking with Lynette Zang. She's the Chief Market Strategist at ITM Trading. Lynette, as always, your insights are very valuable to our listeners, and you're very popular with us. So thank you, as always, for joining us here on Reluctant Preppers.
Oh, yes. And just for those that are new to watching us, what ITM does is we're a full-service physical precious metals brokerage house, and we do specialize in gold and silver. But mostly what we do and what we really like to do is create strategies for people to help them weather the upcoming hyperinflationary storm. And I love you because that's what you guys do: food, water, energy, security. What I do is barterability and wealth preservation with the gold and silver.
Thank you so much, Lynette. We've got to run, but thank you for joining us.
Oh, it's my pleasure. See you next time.
Take
Bye.
care.